In this video, I'm going to explain what a bid-offer spread is and what we need to pay attention to when we're trading or investing. Hello, I'm David Jones, and in this latest jargon-busting video with Trading 212, I thought we'd take a look at the idea of a bid-offer spread, or a bid-ask spread, as it's also referred to. I think it can be maybe something that's slightly confusing for new traders, but there's no need to be. All markets have two prices, a price you buy at and a price you sell at. The spread, depending on the market, isn't necessarily set, and it can vary throughout the day. So first of all, let's just deal with the basics. Let's have a look at some example spreads and where we would be buying and where we would be selling. Let's explore this idea of a bid offer. Let's talk about shares first of all. Let's say you look at the closing price of your favourite share, and the closing price on the day may have been 500p if we're talking about a UK share. But that really is only part of the story, because all markets typically have a spread, a bid offer or a bid ask spread. So if you want to trade, when you look at it in the trading ticket, the price might be quoted something like this. So on this side, this is the bid, and over here, this is the offer or the ask price. So what this means is this is the spread, okay, the difference between the price you can sell at and the price you can buy at. So if you want to buy now, you'll pay 501. If you want to sell, in this example, you'll pay 499. And spreads will vary for markets that see a lot of volume. So larger shares, indices, currencies, commodities, they tend to have very tight spreads. But if we're looking at maybe a share, for example, that doesn't trade that much, or an obscure currency pair, they'll have a wider spread. And the concern to us amongst traders is how much does the market have to move for us to be at break even? Because clearly, if we're buying here at 501, if we decide to sell straight away, we're going to have a loss. The market needs to move, in this example, 2 points, 2 pence for us to have a break-even trade. If we were trading something that had a 50-point spread, then clearly it needs to move 50 points in our favour for us to break even. But as usual, I think this makes a lot more sense when we look at it on the trading platform. So it's important to understand that typically all markets have a spread. You know, in the old days, it was set by a market maker. These days, it's probably more likely to be set by traders putting in their own bids and offers into electronic trading systems. But typically there is a cost of doing business in the markets, albeit quite small. But to get a feel for maybe some of the different spreads, let's take a look on the trading platform at some real markets and what their spreads look like. So we're on the trading platform, and I thought to start things off, let's just stick with UK shares to start with. Let's take a look at this one, British Petroleum. You can see there's a sell price, there's a buy price. It's a big company, sees lots of volume during the day, so you'd normally expect to see a tight spread. And that's what we've got. If you're a seller, you're selling at around about 521. If you're a buyer, you're buying around about 522. So the spread is typically, in this example, while we're looking at the market, around about a penny, just over a penny, a fraction over a penny, because it sees lots of volume throughout the day. So the cost of doing business in what's known as a liquid share like this, referring to how much volume it sees, tends to be fairly low because the spread is tight. Then let's take another company, this one up here, MTC. This is the UK retailer Mothercare. It's quite a small company in terms of how much it's worth, just over £100 million compared to the billions that BP is worth. But so look at the difference. It sees less volume during the day, and you can see the price isn't changing. We're not seeing much trade going through. But if you're a seller, you're selling at 65, and you're a buyer, you're buying at 67.6. So the spread straight away is wider. And as a percentage, of course, that 2.6p spread is quite a big percentage of the overall price, whereas a 1p spread on a 520 share really is a tiny percentage. So this is how spreads work. For high volume markets, we have tighter spreads, and for ones that don't see the same sort of volume, we have the slightly wider spreads. The cost of doing business is a bit more. Let's take a look at a popular currency pair, Euro Sterling. Let's just bring up the detailed trade box for that. So we can see the spread. So if we wanted to trade 10,000 in this example, if we're a seller, we're selling at 88.70.7. If we're a buyer, we're buying at 88.72.3, and of course the price is going to change. But you can see here the spread is incredibly tight. So this is one of the reasons that foreign exchange trading appeals to people, because you have a decent level of volatility, and because as a market it sees billions of dollars moving through every day, the spread is very tight. So it makes it, in terms again of cost of doing business, a relatively inexpensive market to trade in, because the market never has to move that far in your favor to cover the cost of the spread. In this example, it's about 1.2 spread it's showing at the moment. You can see it just there in the middle. The spreads will change throughout the day. Sometimes, if the market maybe sees less volume, you may see spreads come out, but it's a good rule of thumb to maybe help identify markets that are seeing more volume than others, and which may be more suitable markets for short-term trading rather than investing. And just one final thing on spreads. With trading 2-on-2, some markets have a zero spread. So actually there is only one price, which is something of a rarity. So you don't have this bid and the offer. So it's for some of the major currencies. I'll type in zero up here, you can see, and there we have the markets. Euro dollar, zero spread, pound dollar, dollar yen, dollar Canadian dollar, and dollar Swiss. Let's just bring up one of these just to show you how this zero spread works. So I've brought up pound US dollar zero spread. Let's right click, open up the trade box, and straight away you can see the bid and the offer, or the ask, are exactly the same. So we're trading on just one price, whether we're buying or selling. You can see in the middle here, the spread is zero. So that's for pound US dollar zero spread, and those 4 other zero spread markets I showed. So hopefully by now you can see that there's not a catch to having spreads in the market. It's just at the cost of doing business. And for traders, tight spreads tend to be the most attractive. So one thing to be aware of, if the market you trade normally has, let's say, a 1 or 2 point spread, and you look at it and the spread is maybe 10 to 15 points, it could be because volume's really thin. Let's say over the Christmas period, for example, we saw some of the spreads go wide, or the market's just open. So there may be a better time to trade. If you're looking at individual shares, you may not care about a wider spread, let's say a 5% spread on a smaller share, because you may be expecting the share to go up 30% over the next year. But you just need to be aware of this cost of doing business, and I think particularly when trading, how far the market has to move for you to get to a break-even position. So that's how spreads work. It's just a normal part of trading. You can see though with zero spreads for those major currencies, those 5 currency pairs, there isn't actually a bid offer that you have to pay. But in most markets, there is a cost to being involved. We'll wrap things up there. I hope it's explained I think it's a simple enough thing to understand, but I think for plenty of people who are new to trading, they may wonder why they're seeing 2 prices, and it's clearly just one you sell at and one you buy at. But if you have any questions, leave us a message in the comments down below. We do read them all. If you like the video, click on the thumbs up. And as usual, we do lots of different videos. Analysis of the 4 major currency pairs. We look at oil and gold on a weekly basis, technical analysis videos, and ones like this, jargon busting. So to never miss out on the videos that we do, if you click on the subscribe button there, and there should be an alarm bell notification thing down there somewhere. If you click on that, you get automatically notified every time we upload a new video. But for this week, from me, David Jones, and Trading 2-on-2, we'll leave it there, and I hope you have a good trading week.